Hey, welcome to The Explainer. If you're new to Canada or maybe just filing taxes for the very first time, it can feel, well, a little overwhelming, right? So today we're going to break down the Canadian tax system piece by piece. Our goal? To take all that confusion and turn it into real confidence.
All right, so let's jump right in with a big question, maybe the most important one. When you file your taxes in Canada, is that just a chore, a duty you have to do? Or is it actually a right that can work for you?
See, a lot of people think about taxes as this one-way street, right? You just pay the government. But here in Canada, it's totally different. It's more like a two-way conversation between you and the Canada Revenue Agency. That's the CRA. And trust me, getting involved in that conversation is absolutely vital for your financial life here. Okay, let's just bust a huge myth right off the bat. This is something so many people believe, especially newcomers, and it can be a really expensive mistake. Here's the thing, and this is so important. Filing a tax return, even if you made zero income, is literally the key that unlocks the whole Canadian benefit system. It's how you tell the government, hey, I'm here. And once you do that, boom, you could be eligible for things like the quarterly GST/HST payments or the Canada Child Benefit if you have kids. It also kicks off your RRSP contribution room. That's your retirement savings space. So really, think of it like this. Filing your taxes is how you officially join Canada's financial club. And on the other hand, if you're supposed to file and you don't, well, that can cause some serious headaches. The CRA, they will eventually catch up and demand you file. But by then, you could be looking at penalties and interest on top of anything you owe. But honestly, the bigger problem is you're just locked out of the system. You miss out on all those benefits, and you won't get that super important document called a Notice of Assessment. And as you're about to see, that thing is like your golden ticket for pretty much everything financial in Canada. Okay, so now you get why it's a huge deal to file. But the next question is pretty obvious, right? Do I actually have to? And the answer to that all comes down to one key idea: tax residency. All right, and let's be super clear about this. Tax resident has nothing to do with your immigration papers or your passport. It's a term the CRA uses, and it's all about your connections to Canada. Do you have a place to live here? Is your spouse or family here? Got a Canadian bank account, a driver's license, maybe even some furniture? All these little things are what the CRA calls residential ties, and they're what make you a tax resident. And why does this matter so much? Here's the absolute bottom line. If you're a tax resident, you have to report your income from everywhere in the world. That's right, worldwide income. Your job here, maybe some investment income from back home, rent from a property overseas, the CRA needs to know about all of it. Now, if you're a non-resident, you only have to report income you earn from Canadian sources. It's a huge, huge difference. Now, I know what you're thinking. Residential ties sounds a little fuzzy, right? Well, don't worry. The CRA also has a really simple black and white rule. It's the 183-day rule. If you are physically in Canada for more than 183 days, that's basically half the year, you're almost always considered a tax resident for that year. No gray area there. Okay, let's shift gears and get practical. How does this all actually work? Think of this next part as your roadmap for the whole tax filing journey, from A to Z. So the Canadian tax system follows a really predictable yearly cycle. The tax year is just the regular calendar year. It ends on December 31st. Then filing season usually gets going in late February. The big date to circle on your calendar is April 30th. For most of us, that's the deadline to both file your taxes and pay anything you owe. Now, a little heads up for all the self-employed folks out there. You get a bit of an extension to file until June 15th. But, and this is key, your payment is still due back on April 30th. All right, so when it's time to actually send everything in, you've basically got three options. You could go old school, print everything out and mail in a paper return, but just so you know, that is by far the slowest way. What most Canadians do is use CRA-certified software. You've probably heard of TurboTax or Wealthsimple to file online themselves. That's called NetFile. Or you can hire a professional, like an accountant, and they'll use a system called eFile. Honestly, both electronic ways are super fast, they're secure, and you'll get any refund way quicker. So you've gone through all the steps, you've done the calculations, and there it is, the final number you owe. But have you ever really stopped and wondered, what am I actually paying for? Where does that money go? Because it's not just one single thing.
Your total tax payment is usually split into three big chunks. First, you have the federal income tax that goes to the main government of Canada. Then there's your provincial income tax, which pays for services right where you live. And the third piece is your contribution to the Canada Pension Plan, or CPP for short.
And I really want to pause on this for a second, because this is a super important point. The Canada Pension Plan, the CPP, is not a tax. It doesn't just disappear into some big government fund. It's a mandatory savings plan. Every single dollar you put in is tracked under your name in your personal account, and it goes directly toward building the pension you'll get when you retire.
So how do they figure out how much you pay? Well, you don't pay anything on the first little bit of money you earn. After that, they take a percentage of your income, but only up to a certain limit. And here's the best part. If you work for a company, your employer has to match what you put in, dollar for dollar. So they're essentially doubling your retirement savings for you. Now, if you're self-employed, just remember you have to cover both halves, the employee and the employer part. All right, you did it. You gathered all your papers, you filed your return, you paid what you owed. You might think you're done, but not quite. Now comes the waiting game for the single most important piece of paper the CRA will send you all year.
Okay, I want you to burn this image into your brain. Your Notice of Assessment, or NOA, is your financial passport in Canada. Seriously, it's the CRA's official response to your tax return. And this one little document, it holds an insane amount of power in your life here.
And here's exactly why it's so critical. You want to go get a car loan or apply for a mortgage, they're going to ask for your NOA. Trying to rent a new apartment? The landlord is definitely going to want to see your NOA. Thinking about sponsoring a family member to come to Canada? Yep, you need your NOA for that too. It is the one and only official proof of your income. Plus, it gives you other vital info, like how much you can put into your RSP next year. But just a heads up, getting that NOA doesn't mean it's case closed forever. The CRA can still follow up. It's actually pretty common to get a letter asking for receipts for something you claimed, like medical expenses or charitable donations. Don't panic, that's a normal part of the process. If they do find something that needs to be changed, they'll send you a notice of reassessment. And always remember your rights. You can actually go back and ask for a change to your tax return for up to 10 years. So, as you get ready to tackle your own taxes, just remember what we talked about today. This isn't just some chore you have to get through. It's about claiming your rights. It's about unlocking the door to the whole financial system here in Canada. It's truly the very first and maybe the most important step you can take to build your new economic life here.